Inflation is a big deal. Not only does it affect the price of everyday purchases like gas, coffee, and groceries, it also has a huge impact on your investments. In general, inflation makes stock prices go down in the short term, like way down. That's why back in February of this year, the NASDAQ, which is a stock market index of mostly tech stocks, went down over 10% in less than a month. That's a huge move. The market was at the time very focused on the looming prospect of inflation. So if you've ever wondered what inflation is, how it affects your investments, and what the connection is between inflation, interest rates, and stock prices, then you're definitely going to want to watch this video. I'm going to talk about the three main reasons why inflation might be a concern right now. I'll also talk about how and why inflation affects financial markets and asset prices. And finally, I'm going to talk about what you can do about it so that if we do have inflation, you can protect yourself and potentially even benefit. We're getting into a bit of macroeconomics 101, and we have a lot to cover. So grab a coffee and let's get started. There are three main reasons why inflation is a growing concern at the moment. The first reason is the huge amount of fiscal and monetary stimulus that the government has injected into the economy since COVID-19 hit. Most recently, there's the $1.9 trillion stimulus bill that Joe Biden recently signed off on. And last year, there was the $2.2 trillion CARES Act right when the lockdown started. And of course, there's also the $3.4 trillion of money printing from the Fed since the coronavirus hit. That is a ton of money coming into the system, and all that money has to go somewhere. Households are sitting on a lot of cash and they're just waiting to deploy all that once the economy opens back up again. The second reason is the possibility that the economy will have a much stronger than expected comeback. As lockdowns get lifted and everything just comes back to normal, there will be a lot more demand that has been pent up for goods and services. So there is a concern that all of this sudden demand will cause upward pressure on prices. The third and most important reason why inflation is a concern right now is the Fed's revised approach to inflation. At a speech a couple weeks ago in Jackson Hole, Wyoming, they basically revised their approach, their typical approach to managing inflation. Normally, the Fed has an official mandate to keep inflation just under 2%. However, earlier this year at that speech, they basically said they would be okay with letting inflation go higher than that, and that they would be a little bit slower to act on it. This came as a surprise to investors and caused what was a huge reason for the recent stock market sell-off, because the market likes consistency, especially from the Fed. It does not like surprises. Bottom line, there's a lot of reasons why inflation used to not be a concern, but now it is. And this is important because inflation, if it does indeed materialize and inflation is higher and more than the market is expecting, it could cause stock prices to temporarily crash. So at this point, you might be wondering, what does inflation have to do with stock prices? Well, that's what I want to explain next. Inflation affects financial markets and therefore stock prices a lot. And here is why. When inflation becomes a problem, the central bank can usually fix it by raising interest rates. When interest rates go higher, or when the central bank raises them, you're less likely to run out and buy stuff on your credit card, right? Because the rate on your card is higher. Also, companies are less likely to take out loans since the interest rate is going to be more expensive. And so they won't be able to borrow money to invest in businesses and so on and so forth. Also, people are less likely to run out and buy houses since mortgage rates have also gone up. All of this has a ripple effect throughout the economy. So raising interest rates drastically reduces demand. And it's the number one tool that central banks have in order to keep inflation under control. I also want to point out that there's actually two types of inflation: unexpected inflation and expected inflation. So overall, inflation is a fact of life, right? It happens at a rate of roughly 2% a year, and everyone already kind of knows this. This is the kind of inflation that we already expect. And it's easy for central banks to preemptively raise interest rates here and there to keep inflation under control. But then there's the unexpected kind of inflation. This is the bad kind of inflation. Well, all inflation is bad, but this is when inflation just comes out of left field and it's a lot harder to deal with because it comes as a surprise. And all of a sudden, the central bank will have to scramble to do something about it very quickly. This usually means hiking interest rates without a lot of prior warning, like really slamming on the brakes. This tends to cause a lot of chaos in the market because, again, like I mentioned before, the market hates surprises, especially when it comes to changes in interest rates and anything that the Fed is doing. So the market likes low interest rates. When rates are low, stock prices tend to be high. So low rates are very supportive for stock prices. And then on the other hand, when rates are high, that tends to be bad for stock prices. High rates usually means lower stock prices. So they have an inverse relationship. Without getting too much into the weeds here, that's because low interest rates make stocks more attractive. When rates are low, all I'm going to get parking my money in a bond is like 0.1%. So I'd much rather buy stocks so that I can make a higher yield. So when interest rates are low, that increases demand for stocks because stocks are pretty much the best yielding alternative. And then on the other hand, when interest rates are high, stocks are not as attractive. And because everything is about opportunity costs, right? If I can invest my money here and make X% versus over there and make X%, I'm going to weigh the balance between the return and the risk and make a decision. Let's say interest rates are really high right now, like 10%, just to use an exaggerated example. That means I can park my money in a riskless treasury bond or a high yield savings account and make 10%. That means I probably don't want to invest in stocks because maybe I'll make more in stocks, but 10% isn't bad and I can make 10% taking no risk versus investing that in stocks and taking a lot of risk and only making a little bit more. So basically, it all comes down to that inverse relationship. Low interest rates means high stock prices. High interest rates means lower stock prices. Since low interest rates are the reason for elevated stock prices today, a sudden interest rate hike would cause stock prices to drop. Like in the 1970s, when inflation started going out of control, like into the double digits, the Fed had to slam on the brakes by raising interest rates very quickly, from 5.75% to 13%. Coincidentally, or not so coincidentally, in the exact same time frame, the stock market also went down by almost 50%. So now you know, if inflation goes out of control, it's not going to be good for stocks in the short term. This is especially true for hot growth stocks. Hot growth stocks nowadays have sky-high valuations that are all based on ultra-low interest rates. So if interest rates go up a lot, these stock prices have a long way to fall. So that's it for the macroeconomics 101 portion of this video. All right, so inflation might be a thing in the near future, right? So the real question now is, so what? Now what? What do I do? Before I get into my recommendations, I want to clarify one thing. In the short term, surprise inflation, or the unexpected kind of inflation, is bad for stocks. But in the long term, stocks actually do a really good job of outpacing inflation. This is a very important distinction to make. To put it a different way, in the short term, if inflation happens, you don't want to be in stocks. But in the long term, you do want to be in stocks because of inflation. Don't worry, I'll explain further. As I explained, if inflation and interest rates go up, stock prices will come down in the short term. So you could take advantage of the short-term effect by buying stocks that have gone down. Which means if you've had your eye on tech stocks but haven't bought yet because they looked too expensive, this might present some good opportunities to buy them after they've come down. So that's the first thing you can do. Get ready to buy the Googles, the PayPals, the Teslas, and Netflix of the world. Because once again, in the short term, inflation is bad for stock prices. They make them go down. So that's how you can capitalize on inflation in the short term. Start creating your watch list of stocks that you want to buy when the market dips. For a handy cheat sheet to help you figure out which stocks you might want to buy, check out my free stock investing checklist. It's a really handy PDF and it takes you through the whole stock research process step by step. And I know you're going to love it. It's really good. One subscriber of mine used this cheat sheet to pick out stocks during the coronavirus crash last year, and her stocks are now up over 100% since she bought them. So just go to rosehan.com/stock checklist to download it. I'll also drop the link below. So anyway, back to inflation, short term and long term. So in the short term, inflation is bad for stocks, which could create an opportunity for you to buy. But in the long term, stocks actually do really, really well against inflation. The best way to outpace inflation in the long term is by investing in stocks. And the worst place to be in is cash. Over the last century, according to this Vanguard study, cash has returned basically 0% after accounting for inflation. Whereas over the last century, stocks have returned 6.75% after accounting for inflation. So out of all the asset classes, even over real estate and commodities, stocks are hands down the best long-term inflation hedge. So if you keep your life savings in cash for the rest of your life, you're going to be in for a nasty surprise 30, 40, 50 years down the road when the price of everything is 5 times higher, but your money hasn't grown at all. Another great way to protect yourself from inflation is to invest in TIPS, or Treasury Inflation Protected Securities. TIPS are US government bonds where the interest rate is linked to inflation. So if inflation goes up 5%, TIPS will also go up 5%. They provide direct one-for-one protection from inflation. Although they're not high growth investments like stocks, they'll definitely pay off in times of high inflation as well. And unlike stocks, they will actually always protect you against inflation and always perform well in inflation, in the short term and in the long term. A really easy way to invest in TIPS is by buying a TIPS index fund, such as Fidelity's FIPDX. Now, I know I titled this video as if I'm 100% sure that inflation is coming, but obviously I'm not 100% sure. Even though it seems very likely and the market is expecting it and there are signs of it, it also might not happen, right? Or maybe it'll happen, but it won't be that bad. So despite your best efforts, no one has a crystal ball. When it comes to the stock market, there's always something that the news headlines are focused on, and there's always something to be afraid of. Right now, it's inflation. But that doesn't mean you need to be glued to your news feed and make changes to your portfolio every single day and worry about it. It's just good to be aware of. It's good to be aware of whatever the market is focused on at any given moment and how that might affect your investments and how you might potentially benefit. So to summarize, if inflation does occur, it'll probably be very short term, and that will present an opportunity to potentially buy stocks at a discount because inflation usually makes stock prices go down in the short term. And again, that's because of the relationship between inflation and interest rates. Remember, higher interest rates, higher inflation equals lower stock prices. And then over the long term, the best way to outpace and protect yourself from inflation is to invest in stocks. Maybe you've noticed by now there is a difference between short-term and long-term thinking. Yes, in the short term, you might want to get out of stocks if inflation makes the prices go down, but in the long run, you still want to be in stocks. So if you take away anything from this video, it's basically to just stay invested. Of course, assuming you already are invested, because we're not really sure what's going to happen in the short term, whether inflation will really materialize or not. But we do know that over the long run, inflation does happen. And the best way to protect yourself against that is being in stocks. So no need to go run out and do anything. I just wanted you to be aware of what's going on right now. In an uncertain world where we don't have a crystal ball, the best we can do is just try to educate ourselves as much as possible, follow well-informed strategies, and not react irrationally to news headlines, and most of all, keep a long-term horizon. And of course, if you could use some step-by-step guidance on how to find good stocks, be sure to grab my stock investing checklist at rosehan.com/stock checklist. You can also just click the link below in the description. Hope you found this helpful. I post new videos every Wednesday about making money, saving money, and investing money. So if you liked this video, don't forget to subscribe to my channel. Thank you so much for watching. I appreciate you, and I will see you next week, same time, same place. Bye.